Hey guys, I am packing up right now for the first ever Steady Trader workshop in Orlando, Florida coming up. We're going to be doing this all over the country. In fact, we try to do it all over the world. And as I'm doing this, I've got the camera equipment and everything else here, laptops, power MacBooks, all these things. But what I do want to quickly go over today is something that I think is still one of the #1 mistakes that people make in terms of trading, and that is this notion of trying to buy a stock before it is actually breaking out. So let's define #1 what breaking out means, and #2, the danger of buying something before the breakout. So this is all about waiting for confirmation. Let's head over to the charts.
Okay, so let's first of all define what a breakout actually is. So we're looking at a chart here. This happens to be the Russell 2000. It's represented by an ETF called the IWM. So very simple. What you tend to have in the stock market is sort of periods of consolidation like we're having right now. Okay, that's this kind of stuff that are usually then followed by either a move higher or a move lower. So a breakout is what we define this move out of a period of basically consolidation or sideways trotting or maybe another type of format. There's different types of consolidation patterns. It also depends on the time frame that you're looking at. For example, here you would have labeled this a consolidation period. And then you can see we resolved lower for a bit and then we rejected higher. So consolidation periods are usually followed by some sort of a breakout. So the #1 mistake that I believe people make, however, is trying to anticipate a breakout. And this is something that I think is so essential and crucial to prevent to do that I really just wanted to make another video on this. And particularly right now, as of the time I'm recording this, you can see this is a daily chart. Each one of these bars here is 1 day. You can see this index, this Russell 2000, is extremely stuck in a range. And if you look at it a little bit more closely, you can see there's plenty of times here where it tried to break in one direction or another, but then just once again got rejected. And so what's the most important thing to do here, in my opinion, of having done this for a long time, is to wait for a breakout to take place in either direction on a daily closing basis or on a 5-minute closing basis, whatever the time frame is that you're looking at. If you're a day trader, you look at 5-minute charts, make sure you have a breakout or a breakdown out of this range on a 5-minute basis. If you're looking at daily charts, which is more my style, like swing trading, multi-day, multi-week, multi-month approach, you want to make sure that in this case, the Russell 2000 actually closes above this sort of level here. It has to actually close on a daily basis above this area. It has not done so. It's also not close below here, as you can see. So this is a really, really important, folks. I really hope you guys understand this and you don't make the mistake of anticipating breakouts, because if you anticipate them, you're going to more often than not get chopped up. Yes, absolutely. There's a potential that you're going to miss some initial moves because you won't be positioned for it. But once you see the breakout last, if you're looking at a daily chart and it sticks for at least a few hours, you can probably already go in and leg into an initial position if you are looking at the daily chart. So just a little bit of a tip here. I hope this makes sense.